couple of questions here. I'll break them down because it's kind of a flip of two sides. The first question is, can you explain the reasons for the current lag in returns compared with the benchmark?
So I think, as I mentioned earlier, 2023, 2024 were very disappointing years for us, and we have acknowledged that in the past, and we apologized then, and we continue to apologize for disappointing people. Now, we don't like to disappoint people, but we think sometimes it is a potential outcome of a decision that we're willing to live with. And we have to think about these things separately. We, in 2023, 2024, found that a lot of equities, especially the Magnificent, what then became known as the Magnificent Seven, were just extremely overvalued. And you've seen them go up in price a lot, and we've missed out on that. And that has really hurt our relative performance. And we stuck to our knitting, we maintained our conservatism, and we were hoping for things and for the market to wise up earlier, and it hasn't. But we saw in 2025 how quickly things can turn, especially in that area of the market, once the risk-on mentality starts to wobble. And we think this is just the beginning of what's to come. And we've seen how well our portfolio has done in that kind of environment. And at some point in April, when the market was down double digits, we were actually up. So we know that our portfolio has been positioned for a while in this matter. It's not easy having resisting FOMO, right? It's always been and it will always be the challenge for investing, but it's the right thing to do, and it's something that we've always prided ourselves in doing. You know, I was showing Aubrey earlier my suit at the inside. Instead of my name, it says actually no FOMO, and I guess I have a hat here. I'll put it on. I'm talking about no FOMO, but the truth is, you have to have no FOMO. It's the easiest thing to do, to fall for these things. And investors do every now and then. But once things turn, it becomes extremely, extremely painful. And we will never take risk with our investors' hard-earned savings, hoping to make a little bit of money over 1 year or two while exposing them to a permanent loss of capital. And we believed at the time and continue to believe that buying things at such high valuations is a huge risk that we're not willing to take. We think it will turn. We're confident that our portfolio is going to perform well in that environment. Is it going to happen next month or this year? I don't know, but I'm very confident that what we saw is a harbinger of what's to come.
I have the same confidence as you do, but if it doesn't turn out that way, I think the thing is we're still going to do the safe thing. We're still going to take the sensible approach. You know, maybe there are some people out there who are massively overweight US, overweight Tesla, Bitcoin, and you know, to me, that's the sort of person who's walking around with a lit cigarette and match through a firework factory. You know, they might get through it alive, and great on them if they do. And, you know, I hope they do in many ways, but it's not sensible.
No.
And I don't think owning a portfolio like that is sensible in this market. But you know, I don't think taking risk in, you know, excessive risk in names like Tesla is sensible. But sometimes doing the sensible thing does not pay off as well. And that's just something that we have to live with, and we have to have the patience to go, well, you know, in the long run, it really does work, because, you know, we don't sort of become a firework factory that explodes.
Well, when we started out, we said our goal is to generate attractive risk-adjusted returns. And there will be times in the market cycle where generating high returns comes with unacceptable risks. And in those scenarios, our job is to protect our downside, prepare, but not do anything silly.
So do you think now then, bearing in mind our consistent messaging to our clients over this last few years and our process, and we stuck to our knitting. Do you think that our process, do you think everything is now being validated and that we're in a good place?
What happened here today, and especially what happened in April, just shows people the risk reward that's embedded in the market and the risk reward that's embedded in our portfolio. And it shows you how positioned we are. And I don't think this volatility that we saw in April is the end of it. I mean, I don't know what's going to happen. I can't tell you numbers, but I think we are in an environment where there's going to be increased volatility and increased risk. And in that environment, I think our strategy will shine. I think the returns that were generated in 2023, 2024 were generated with unacceptable risks. And I think we have different kinds of risks today, but I think it's an environment where what we do is going to work better. And as Aubrey said, our goal in the end isn't to predict what the market or what everyone else is doing. Our goal is to make sensible decisions and generate good returns without taking silly risks for our clients, knowing that over time, that should lead to outperformance, but over any shorter period of time, it may not. And that is just basically what we think we should be doing.